And welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'm going to be your host for about the next 20 minutes here on Options Guide TV. We are going to look at our trade that we set up. We set up we set it up on Wednesday in Amazon. We're heading into Amazon's earnings on February 6th. We have a lot of earnings that are basically, we're in the heart of earnings season right now, and in particular in the Mag 7. The first big cap company that announced was Netflix, and they knocked it out of the park, said a lot of good things about subscribership. They are looking to add cost to their platform again, but they are just basically the leader in the space, and they're still, no matter who tries to step in, they just seem to beat them down and continue to add subscribers to their platform, and the stock is showing it. So next week we have the biggest one is probably Apple, especially considering that Apple has really struggled to well, first of all, they gave away their place as the most expensive company in the marketplace, and NVIDIA took over after Apple's downturn recently in the underlying stock. And they're going to announce earnings, and they're going to be announcing next week on Tuesday. We got Visa, we got MasterCard that's announcing earnings. We have just a plethora of companies. And then after that, then we get into the February, into end of January, beginning of February, and we start seeing PayPal, Google, Uber is going to be announcing, Qualcomm, all these different stocks are going to be announcing. So this week, I'm going to just adjust the Amazon trade today and just do a little rollout on the downturn that we had on the stock. So if we look at the chart, let's go to the Tradier Pro software. And if we look on the chart, we actually see that we have a little bit of a downturn in the marketplace. We closed just the other day at 135.40. We're down to 234.22. We did sell an option contract that is expiring on the 31st, which is a week from today, and that trade is profitable at this point in time. And what I'd like to do is, or I should say that option contract that we are short is profitable. And I would like to take that and actually roll that out until the February 14th expiration. So we're just going to roll this position into a bull call spread or a call vertical spread, just very straightforward. And then we'll be riding that position into the earnings. So implied volatility has gone up on the trade. The trade is actually doing fairly well, mainly because of the way that we set up the trade. So here's Amazon right now. It's at 234.10. It's down 0.5%, down at $1.32 on the day. The February 14th contract is the one that we bought. We bought the 245 strike. So here's our option contract that we bought. And we sold the January 31st expiration. So this expiration is the one that we sold, and we sold the 247 strike call right now, and that's trading for 30 cents. Okay, so we're going to sell that. All right, so when we put on this trade, we put it on for $4.12, and we now see it trading for $4.45. So we have a small gain on that position. But more importantly, we've made about half the premium here on this option contract, the 31 strike. So now what I'd like to do is just take this option contract, and we're just going to roll it. And we're going to roll it out to the same expiration as that we purchased. Now, I when I look at this, I wouldn't mind paying 20 cents for it or 15 cents, like waiting a little bit today to see if this downturn continues. The marketplace just in general is showing a little bit of weakness. We have the VIX index right now at 1473. That's down a little bit today, but the S&P 500 index, I guess it's bounced back. It's a little bit flat. Russell 2000 index is basically flat, and the NASDAQ is down 0.25% also. So looking at these trades and across the board, what we want to do is we want to take our short option contract and buy to close that contract, and then we'll roll out to the January 14th expiration. So our cost basis on this entire trade is $4.12. We're going to be making about half the premium on the 247.50. And like I said, I might wait a little bit to the end of the close, but I'm going to show you the steps of it right now. And we're going to remove this option contract because that is the one that we are long, and we're not going to touch that one at all. We're going to take this 247 strike call, and this would be a buy to close, but we're just going to click buy to open because that's the only way that it will allow me to do this, because this position isn't in this test account. And then we're going to go back to the February 14th expiration. And if we look at the 250 strike, we can bring in $3.45, and that's within the one standard deviation move. If we look at the 255 strike call here, we're also bringing in $2.35, and that's up closer to the delta here is 20. We're almost at a one standard deviation move at the end of this, and that will give us a little bit more upside. So we're still bringing in a lot of premium on the trade. We've made a little bit on our one option contract that we, I guess that we sold waiting for that expiration date on the 31st. So we're up about 50. Well, we made about 40 cents on that option contract just in general. So here's the trade. We're going to be rolling out to the 255 strike call here. And the one that we're long is a 245. That'll give us 10 points of upside. And here's the contract that we would be selling. We're going to click the bid on this. And we're going to bring in a net credit of $2.02 on the trade. And that will lower our cost basis down from $4.12 down to $4.10 or $2.10. $2.10 or $210 as we lead into this expiration date. And we're well within the means of where the underlying stock could go. With the stock right now at 234, the expected move, we'll go back and look at it for that earnings date, but based off of this expiration is around 18 points. And the one standard deviation move is right around the 260 level. It's somewhere between 255 and 260. So very feasible trade as far as the math is concerned. The marketplace, if Amazon comes in and it is a positive trade that has positive earnings or perceived as good news, the marketplace is saying that this move is has the potential to actually happen. So if our forecast is correct, we might be able to hit our high strike of our vertical spread or our long call spread. So here's the ask price. Here's the trade. This would be our official paper trade for today. What we're going to do is take our Amazon position, and we are going to buy to close the January 31st 247.50 strike call, and then roll that option contract, and we are going to sell to open. The same expiration that we're long, the 214 strike, or the February 14th 255 strike call. We're going to do this for a net credit of $2. We'll call it $2.03. Let's just call it $2. $2 is the bid right now. Probably get it filled closer to 204. Yeah, we'll say 204 at $2.04 for this trade. And when that trade is done, here's what our final position would be. So I close this out. This one goes away. And we would end up being long the 245 here and short the 255 going into this expiration. And that's where our final position would be at. But we'd have it at a lower cost basis. We'd own it down around $2.02. And our trade worked out in that I'd like to extract a little bit more of that premium, but there's an opportunity with the market downturn to buy to close that position and make a little bit of profit on our shorter term option contract, and then get set up for the earnings date that's coming. And it took them a while to announce, but as always, Amazon announces on a Thursday, and then you have the Friday expiration. So as this expiration approaches, we will probably put on another position, which will be some type of butterfly, and they will announce on a Thursday, and we will then have 1 day for those option contracts to live on a Friday. And I always like to look at butterflies or something that wants implied volatility to come in or go down. So you have an expensive underlying, you have an expensive situation in that they are announcing earnings. They do it on a Thursday all the time, Amazon does, and that pumps up implied volatility. But then the option contracts only have 1 day to live to go to the expiration. This is the entire concept of daily option contracts. You get all of this situation that happens, and then you have all of that juice, all of that time decay. Everything has to go away because there's only 1 day remaining to expiration. So it always makes it interesting to be trading options on that day. But for now, this is all that we have. We have just rolled our diagonal spread in Amazon from the January 31st expiration out to the February 14th expiration. Now, going into the markets, we're showing a little bit of weakness today, but actually I guess there was a little bit more weakness on the open. But I'm still a little befuddled on exactly where the marketplace wants to go to next. It's going to be big on earnings, and all the Meg 7 announcing the drivers of the marketplace and the bull market in general is all going to be announcing earnings next week, the bulk of them. So I don't think I want to do an S&P 500 index trade. I definitely don't want to do one over the weekend. And also, we just got a new administration, and who knows what the news headlines might be over the weekend. So that's it for this episode of Options Guide TV. I do not see any questions or comments. We'll be back on Monday, and we'll look to do quite a few earnings trades next week. So next week will be an interesting week in the marketplace with that said. So see you on Monday at 11 a.m. Eastern time for the next edition of Options Guide TV. And thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.